Great. So I'll be talking about Deliveroo today. And as we talked about last week, Luke mentioned that this is a company which will be listing on the London Stock Exchange in the next week or two. And so I wanted to take a look at whether we should buy it, because the time is now. So first of all, let's talk about who Deliveroo are. This is the starting point for Deliveroo's business plan. There's a bunch of hungry people thinking about what kind of KFC bucket they want. They don't want to cook for themselves, so they're going to hire a stranger from the internet to come to their house with food. Now, Deliveroo says they're sending this guy, but whenever I order, they send this guy who's taking his sweet time, and I get my food about an hour and a half later. Now, the problem is Deliveroo can't make this guy ride any faster because he's not their employee. Deliveroo has a unique system, well, not entirely unique system, with its workers where they are classed as self-employed. They are subcontractors from Deliveroo, which reduces Deliveroo's costs. They don't have to give them benefits. They don't have to give them minimum wage. So that's an advantage in their cost basis, but it does present some challenges, as we'll see later. So these guys go to the restaurant, they pick up the food, they bring it to you, and they get paid £4, and you pay them for the pleasure. So it's an interesting business model. And in the takeaway market that we can see in Europe, first of all, we can see that the UK is the biggest market by far, but we can also see that Just Eat is a much bigger member of this market. Deliveroo here is the small turquoise patch, Just Eat, the big red bar. So Deliveroo, in its biggest market, is only a small player, possibly third or fourth biggest. Across Europe, we can also see that they are majorly present in France, and they have small presences elsewhere, such as Spain and Belgium. But the UK and France are their biggest markets, and in neither of those markets are they the biggest player in the takeaway market. You can see Just Eat is bigger in both markets. So it's interesting that this company is currently going for an IPO, and it's not necessarily a market leader. Now, Just Eat is a slightly different business model because they don't connect restaurants with delivery drivers like Deliveroo does. They're just an ordering platform, but it's showing in the market share that Just Eat's way of doing it, or at least their longevity, is giving them an advantage. So, moving on, we want to see, is there money to be made with the IPO? Well, when we look at DoorDash in America last year, or Just Eat in 2014, or Grubhub in 2014, we can see that there is a lot of money to be made. DoorDash made 86% on its IPO price within the first day. Just Eat, you could claim 8.5% if you sold at the high, and Grubhub closed 31% higher. So all of these are profits that you could have taken in one day or 1 week if you had bought at IPO and sold on the first day of unconditional trading. So clearly, there's huge money to be made. So we should get in, right? Well, there's also the cautionary tales, like Pets.com in 2000, who opened trading at about $11 and 9 months later declared bankruptcy with their shares worth 19 cents, only 9 months later. So there's an upside, and there's clearly a downside as well. If you had invested in this, you would have lost all of your money. So this is something to consider. But with Pets.com, we have to see, well, actually, when we look at the business, there were a lot of red flags. In fact, there were so many red flags that there were red flags coming out of the red flags. So let's look at what these were. This is the Pets.com mascot. He was a puppet dog, and he was very popular on daytime TV. People liked seeing his adverts come up. But the problem for Pets.com was he was most of their business plan. Pets.com wanted to sell pet supplies online and deliver it to people, but they failed to work out how they're going to do that, and they made losses every single month of every single year that they operated. They didn't know how they were going to become profitable, and they hadn't correctly identified consumer habits. In 2000, consumers were not shopping primarily online. They were shopping in brick and mortar shops that they could walk or drive to, and Pets.com didn't take this into account. They didn't correctly identify the consumer trends. Now, the final problem with their business plan was that this puppet is pretty sus, if you ask me. So they never had longevity, in my opinion. Coming back to Deliveroo, we want to see what are some of the red flags we can see with them. And to be sure, there are some. So first of all, they also make a loss. Every year, they lose money. Their debt gets bigger, and their shareholders claim no profits. So this is quite concerning. Even with the pandemic raging and their revenues skyrocketing, they still posted a $200 million loss last year. And again, the path to profitability is uncertain for them. They've been established for quite a while, but they haven't managed to turn a profit. They haven't managed to tighten their margins in such a way that they can even make $1 from all these cyclists that you see going around. Furthermore, there's a lot of trouble right now for Deliveroo in the near future with UK regulators. UK is their biggest market, as I mentioned. And recently we saw Uber, who has a similar business model in terms of the way they use their staff as self-employed staff. Uber just lost a Supreme Court appeal to say that they now have to give their staff worker status. So that means they have to guarantee a minimum wage, and there's certain benefits they have to provide, like statutory sick pay. So it was kind of a landmark decision. This was only about a month ago, and it's probably going to impact the way Deliveroo's business model operates. And for a company making a loss, they cannot afford more costs for their staff, like benefits, sick pay, minimum wage. Deliveroo can't have that. So big problem there. They also are in a crowded market, as I showed you. There's a lot of people vying for a piece of the pie in the takeaway market, and Deliveroo isn't even the largest share. So there's big concerns about this company. So much so that for this and many other reasons, we cannot call this a lead pass investment. And in fact, I would not invest in this even as a high growth, high risk company. However, there is still money to be made, perhaps trading this company. As we saw with the others, a lot of money was made just on the first day of trading. So to get an idea of if we can do that with Deliveroo, we want to compare some of the valuations and see if this has some upward room to make us some money. So let's look back at DoorDash. DoorDash IPO'd last year, late 2020, and we can see some of their financials here. They pulled in revenue of about £600 million. Now they're in the States, but I've converted from dollars to pounds here. They also made a big loss of £484 million. So similar to Deliveroo, huge losses, even on quite a lot of revenue. But their IPO valuation was $32 billion. So investors didn't really seem to mind the big loss. They were focused on the potential of DoorDash, its growth, its share in the market in the US, and they rewarded it with a big valuation. Now, this valuation is before the price shot up 86% on the first day. The company is now valued at $60 billion. So a lot of potential here. Grubhub, we look at in the US, much smaller revenue, but they managed to turn a profit. Now, what's interesting is investors didn't reward that profit. You can see the much smaller valuation for Grubhub. That shows something, I think, that investors at the moment with these kind of companies are looking at growth and they're looking at market share. And DoorDash's superior revenue gave it a big advantage over Grubhub in its valuation. So that's really interesting to see that the investors aren't worried about profits at the moment. When we look at Just Eat, as I mentioned, this is a slightly different business model, but in a similar industry. So we look at Just Eat, who listed in London in 2014. They have a similar revenue to Grubhub, also making a profit, and got a valuation of £1.5 billion. So again, investors did not reward these tight margins that turned a profit. They rewarded revenue and growth. So that's good news for Deliveroo, because when we look at them, we can see they've got huge revenue, bigger than DoorDash. The UK takeaway market is large, and Deliveroo is raking in the pounds when it comes to their revenue. But as mentioned, they are still making a loss. Now, Deliveroo's target for their valuation is 8.8 billion, so dwarfing Just Eat and Grubhub, who are both profitable, but considerably less than DoorDash. So there's certainly some potential here for upward movement, but we just need to be careful when we compare DoorDash and Deliveroo, since DoorDash listed in the States, where there is a lot more capital available and perhaps a more favorable attitude towards tech stocks and growth stocks. Deliveroo will be listing in the UK, and there's a bit less capital available. So we have to be careful comparing those two. But certainly there's potential for upward movement. So in conclusion, I won't be investing in this, that's for sure. Until they at least turn a profit, I won't even look at them. But as a trade, I think there's a very high risk, very high reward opportunity coming this week. So I'll be interested to hear if any of you have thoughts about whether you'd like to get into Deliveroo. Are there any questions?